All right, guys, so California is providing 20% or up to $150,000 in down payment assistance towards first-time home buyers. And so, see, if you've been wanting to buy a home in the last couple of years and either mortgage rates or home prices have been in your way, this video is for you. Last year around April, the state launched a program called the California Dream for All program, where it provided up to 20% in down payment assistance, where if you bought a $1.3 million home, you'd be able to get up to $260,000 in assistance to use towards your down payment or your closing costs. And this allowed thousands of families to either increase their purchasing power or lower their monthly mortgage payment because of the high down payment to get into a more comfortable range. This program created so much buzz that we literally ran through $350 million in funding from the state of California in about 9 days. And now that program's getting ready to roll out their next round of funding, and that consists of $220 million in funding. So they just released their updated guidelines and income limits. So I'm going to go over these guidelines and everything you need in order to qualify for this program if you're looking to take advantage of it. But before we get into what you need to qualify, I think it's important to understand that it's not free money and the actual payback structure of the program. So the program has a shared appreciation payback structure. So what that basically means is that the state is helping you buy your first home in exchange for a portion of ownership in your home from the time that you buy the home to the time that you sell or refinance. So let's say, for example, you purchase a $600,000 home. The program is going to provide up to $120,000 in down payment assistance, which is 20%. Now that assistance is due back whenever you sell or you refinance, as well as a percentage of the appreciation of your home that's going to be equal to the assistance that you take. So in this case, let's say if you bought at $600,000 and then you sell 5 or 10 years later at $700,000, you have $100,000 in appreciation, right? From the time that you bought at $600,000 to the time that you sell at $700,000. So when you sell the home, you're going to be required to pay back the original $120,000 in assistance that you took when you purchased the home, in addition to a percentage of the appreciation that you got. So from $600,000 to $700,000. So in this case, if you buy at $600,000 and then you sell at $700,000, let's just say 5 or 10 years later, for example, you've earned $100,000 in increased value in your home, which is the appreciation from the time that you bought to the time that you sell. So when you sell at the $700,000 number, you'll have to give back the original $120,000 that you took in assistance and they lent you. You don't have to pay interest on it, and there are no payments made throughout the duration of the loan, but you do have to pay it back. And so now one thing that people get concerned with here is that they feel that they have to come up with $120,000 out of pocket or have that much money saved up to pay back at the time of selling. But if you use that assistance towards your down payment from the start, you already have that $120,000 in your equity of your home. So all you have to do is give it back. Now, in addition to that, you'll pay back 20% of the $100,000 in appreciation, which is $20,000, and then you get to keep the other $80,000. Now, there are some exceptions where your appreciation share is actually lower than that 20% that you have to pay back, but I'll talk about that here in a bit. Also, if you decide to refinance, you'll also have to pay back the assistance then, unless you use the one-time exception that they're allowing you, where you'll be able to refinance assuming you're simply doing it just to reduce your rate and payments, and you've made 12 on-time payments and you don't intend to pull cash out. So it can be a rate and term refinance to reduce your rate, reduce your payment. Your rate has to be lower by a certain percentage like they did last time. This time they didn't specify how much lower your rate has to be, but they are allowing you a one-time exception where you can refinance without having to pay back the assistance that they loan you. Now, how to qualify for this? The first thing we'll go into is eligible borrowers and what it means to be an eligible borrower. So we'll go into what I think is the biggest change in the program. So the program requires that all borrowers on the loan be first-time home buyers. Now, this is no different than it was the first time around. CalHFA's definition of a first-time home buyer is someone who has not been on title or has had ownership interest in a primary residence in the last 3 years. And that hasn't changed. That stays the same. So all borrowers need to be first-time home buyers. The next thing, and this is new, is that the program is requiring that you be a California resident. This wasn't their last time. And I think the reason why they implemented it this time is they don't want people from out of California taking advantage of the program. And I think a lot of these changes from CalHFA and that they have made this time around are really just to try to get the money in the right hands. I think they felt that last time around the money got used up so quickly, and it got used up by people that maybe didn't need assistance or not necessarily in the hands that they intended to put it in. So that's why they're making some of these changes. So the next thing is that you have to be a California resident. Also, in addition to being a first-time home buyer and a California resident, and this was huge, is that at least one person on the loan has to be a first-generation home buyer. So this is completely new, and I think this could disqualify some people because of the definition and the complexity around it. So I'll read what the definition is here for CalHFA. A first-generation homebuyer is defined as someone who's not been on title, held an ownership interest, or have been named on a mortgage to a home in the U.S. in the last 7 years. So you as a borrower could not have been on title, had ownership interest, or been named on a mortgage on a home in the U.S. in the last 7 years. And in addition to that, whose parents, whether it's biological or adoptive, do not have any present ownership in a home in the U.S., or if they're deceased, whose parents did not have ownership interest at the time of death in a home in the U.S. So the second part can be confusing, and it's easy for some people to misunderstand it. At least I've already had several people reach out to me not understanding it correctly, and they think that their parents can't have owned in the last 7 years. Your parents can't actually have previously owned. The rule is that your parents cannot own at the time that you're purchasing. So if they previously owned and they sold a home, let's say in 2019, 2020, 2021, 2022, but do not currently own a home when you're getting ready to use a program, then you would still be considered a first-generation home buyer. And now the third piece of this is, or someone who has been placed in foster care at any time. So if you've not had ownership in the last 7 years and you've been placed in foster care at any time, then you'd be able to be considered a first-generation home buyer. The property does need to be a primary residence, so you cannot use this for an investment property, and you can use it for single-family residences, you can use it for a condo, you can use it for a townhome, but you cannot use it for a multifamily property, even if you intend to occupy one of the units. So if you want to buy a duplex or a triplex, this isn't a program that would be helpful for those type of properties. Next thing we'll go into is credit. And so far, based on the updated guidelines, there haven't been any changes outlined to the credit requirements. The program can only be used for conventional loans, and CalHFA's minimum credit scores for conventional loans is either 680, or if your income is 80% of the area median income, you only need to have a 660 credit score to be eligible. So if you were to buy a home in Oakland, California, your income would have to be below $126,560 per year, or if you bought in Los Angeles, your income would need to be below $84,160 or lower. And if your income is below these dollar amounts in these counties, then you can qualify with as low as a 660 credit score. Now, these limits are different per county. And so if you want to know the maximum income you can make in your city or county, comment below, or you can Google the Fannie Mae Home Ready Income Limit tool and just type in your city or your county, and it'll spit out what 80% of the area median income is for that area. The maximum debt to income ratios allowed on this program is either 45% maximum DTI if your credit score is below 700, or up to 50% if your credit score is above 700, and that is the same as it was last year. Next part is income. So this is one of the changes that was expected to be different from the last time, and honestly, I thought the income limits were too generous last time. I was kind of surprised to see that the income limits this time around are still pretty generous in my opinion. This might just be that I'm used to other down payment assistance programs that have much lower income limits, but when I looked at the new income limits when they came out here a few days ago, I still thought that they allowed enough people to go ahead and be able to qualify, and it didn't disqualify as many people as I thought they were gonna do. So this is good news. The income limits are assigned by county, and so we'll go over a few counties here. So if you purchase in Los Angeles, the limit is $155,000 a year. I think that one can actually be a little bit higher. Los Angeles, for some reason, gets some relatively lower income limits compared to the Bay Area. But Los Angeles is $155,000. If you purchase in San Francisco County, the limit is $277,000 a year. If you purchase in Fresno, the limit's $132,000 a year. If you purchase in Sacramento County, the max is $180,000 a year. And I think Sacramento County's income limits were at like 235 or 265 or somewhere there about last year. So I think for them, it dropped significantly. Contra Costa and Alameda counties are maxed at $234,000 a year. Last time, the income limit for them was $282,000 for these two counties. So I didn't think they dropped that much. And I think with $234,000, that still allows a good portion of people to qualify in these counties. So now when it comes to income, if your income is below 80% of the area median income, similar to how you have a lower credit score requirement with this program, if your income is below 80% of the area median income, instead of the shared appreciation being equal to the percentage of the assistance that you take, you'll have a reduced shared appreciation, which will be 0.75% of the assistance percentage. This can be kind of confusing. So I'll just break down a simple example is if you take 20% of down payment assistance from the program, you'll be required to pay back 20% of your appreciation. But if your income is below the 80% of the area median income in that county, then you can take 20% in assistance and only have to pay back 15% of your appreciation whenever you sell or refinance a home. So it's a 0.75 to 1 ratio if your income is below this limit. And the next thing is assets. So another big change that was made this time around is the maximum that a borrower can come in from their own funds towards the down payment. So last year you could take the full 20% in assistance and come in with an additional 30% of your own money to put towards your down payment, which could make your total down payment about 50%, and actually help someone do this. But this time around, I think CalHFA is trying to get the funds into the hands of home buyers that really lack a down payment. And so what they're doing is they are only allowing you to come in with up to 5% of your own money for your down payment, in addition to anything that you borrow from them. So if you take 20% in assistance, you can come in with an extra 5%. If you take 10% in assistance, you can come in with an extra 5%, but they're capping that at 5% towards your down payment. Now you can still pay for your closing costs. This is just specific towards your down payment. And I'll wrap it up with a few more things here that I think are worth noting is that, one, CalHFA hasn't announced an official launch date, other than saying that the program's coming out in the spring. And based on what I see on the website, I think it'll be sometime in April. Number two is that the program is expected to be set up as a lottery-based type system where applicants will be randomly selected to receive a voucher that's going to allow you a certain period of time to go find a home and use up the funds. Some of the days that have been set are 60 days. So if you get selected for the program, you'll have 60 days to be able to go search for a home, get your offer accepted, get in a contract, and close on your loan. Otherwise, you'll have to give up the funds to someone else. And number three is that it's expected that they're going to try to distribute the funds fairly throughout the entire state. And so they might limit the amount of applicants that get selected in each county depending on the size of the county. So this is interesting. It's going to be interesting to see how this plays out. Once the program goes live, there's a lender training that's happening later this month to iron out some of these details. I know some of the questions that I've gotten is, hey, well, with respect to the first generation thing, what if you have a couple and they're both first time home buyers, and let's say this person isn't a first generation home buyer? So now that leaves us to this person, right? Can this person qualify as a first generation home buyer? Let's say this person has two parents, one of them owns a home, one of them doesn't own a home. That's a unique scenario, but I've had the question come up already 3, 4, 5 times. And so that's one of the things that I'll be asking. And there's just some other things in terms of like, well, how is this going to be proven? Is it just a matter of the buyer and the borrower stating on a document that, to the best of their knowledge, their parents don't own any property at the time? I've had some clients already ask me some questions. They're like, well, I don't know anything, about my dad or mom, or I was raised by this person. And so it can get a little bit complex there. So I'm curious to see how CalHFA is going to handle this. There's already quite a bit of buzz going around on this. There's only $220 million in funding that is available this time around. So we'll see how fast this money goes and whether the state continues to provide funding for this particular program. So hopefully this was helpful for you guys. Let me know what you guys think about the Dream for All program. Let me know what you think about the income limits. Let me know what you think about the first generation thing. Do you think it's helpful, not helpful? What was your experience with it? If you tried to use the program last time, put it in the comments below. There is my contact info in the description below. So if you have any questions, feel free to reach out, and we'll talk soon.